Understanding the invisible money effect. The invisible money effect refers to the psychological phenomenon where people are less aware of, or less conscious of, how much they are spending when using non-physical forms of payment. This can include credit cards, mobile wallets, or digital payment methods. Unlike using cash, which provides a tangible experience, invisible money feels less real and can lead to unconscious overspending. Digital payments and reduced awareness. When people use credit cards, debit cards, or mobile payment apps, they often lose track of how much they are spending. The immediate transaction is not as visible or impactful as handing over cash. This lack of physical exchange can distort a person's perception of the amount they are spending in a given moment. Emotional disconnect from spending. Using invisible money can create an emotional disconnect from the act of spending. With physical money, there's a tangible sense of loss as cash changes hands. In contrast, digital payments feel less personal, which can reduce the emotional sting of spending money and make individuals more likely to spend impulsively without considering the long-term financial impact. Credit card debt and overspending. The invisible money effect is particularly evident with credit cards. Because payments are deferred and not immediate, individuals may feel less responsible for their purchases. This delay in payment can lead to accumulating debt, as people might overspend without realizing how much they are charging to their cards. Increased spending with contactless payments. The rise of contactless payment methods has further intensified the invisible money effect. These quick and easy transactions can encourage impulsive buying, as they require minimal effort to complete. The speed and convenience of contactless payments make it easy for individuals to make frequent purchases without fully processing the financial impact of their decisions. Mental accounting and spending behavior. The invisible money effect is also related to a mental accounting behavior known as splitting money into different categories based on its source. For example, people might treat money in a bank account as savings and money on a credit card as more disposable. This mental split can lead to greater spending, as the perception of wealth or spending ability is distorted. Lack of immediate consequences. One of the primary reasons the invisible money effect influences spending is the lack of immediate consequences. With cash, people experience an instant reduction in their available funds, which provides a clear signal to slow down or stop spending. Digital payments, on the other hand, don't create this instant feedback loop, which can encourage overspending. Increased impulse purchases. The convenience of invisible money also contributes to increased impulse buying. Without the need to count physical money or think about its value, people are more likely to make spontaneous purchases, especially when shopping online or in environments where digital payments are the norm, such as e-commerce platforms and mobile apps. Strategies to combat the invisible money effect. To combat the invisible money effect, experts recommend strategies like setting spending limits on credit cards, using cash for discretionary purchases, or tracking spending through budgeting apps. Being more mindful of digital transactions, checking balances regularly, and limiting reliance on contactless payments can also help reduce the impulse to overspend. The role of financial education. Increasing financial literacy can help individuals recognize the hidden dangers of the invisible money effect. Understanding how digital payments affect their spending habits can empower people to make more informed decisions. Financial education can encourage people to be more conscious of their purchasing behavior and promote healthier spending patterns. Conclusion. The hidden impact of invisible money. The invisible money effect has a powerful impact on how people spend, making it easier to overlook the true cost of purchases. By becoming aware of this phenomenon, individuals can take proactive steps to control their spending, reduce debt, and foster healthier financial habits in an increasingly digital world.